Good morning, good afternoon, good evening, everybody. Hey, welcome to Note Night in America on Monday night. We are always honored to have you guys join us from all across the country, and we've got a very special guest here, a friend for quite a few years now. I've been trading and always touching base with this guy about annually, 6 months. Hey, what's going on? What are you doing in the business? Where do you see things going? So we've got a great conversation for you guys here who are joining us live or also watching the replay or listening to us on our nation network of investors across the country, everybody. So love to have you guys here. Like I said, if you're watching this live, let us know where you're at, what part of the country. We'll try to answer some questions as we get through that. But I wanted to bring up my slide here. We've got a few things. You're obviously here to meet the banker, and we've got like I said, very special conversation tonight, talking about where the market's going, what you're going to do, what we see things and opportunities. But before we dive into that, if this is your first time to Note Night in America, well, welcome. We're glad to have you guys here. They are recorded, so if you've got to bug out after 30 minutes or so, you can always catch the replays by going to weclosenotes.tv. That'll take you directly to our YouTube channel. Make sure while you're there to hit the subscribe button. And feel free to comment on the video, comment on the replays. I answer those. We take questions from there. So always glad when you guys are there. But check out the podcast as well for Note Night in America. All these are up. We're at episode, I think, 65 now on Note Night in America since a week. So listen there. Hey, feel free to leave a 5-star review and also give us a subscription there as well too. So as always, you can check out all our videos and replays on our podcast at weclosenotes.com. But I have to give a big shout out. Thank you to everybody for our big podcast, our 3 to 5 times a week, the Note Closer Show podcast. We exceeded over 25 million listeners on the radio network last month. I forgot to announce that. It's been a crazy, crazy time, obviously. Over 600 episodes, over 625,000 downloads as of now on just the iTunes podcast and anywhere else you listen to your podcast. So thank you as always. You can go to noteclosershowpodcast.com and check out any of the back or current episodes. So review and subscribe. But one of the big things I'm really excited about is something that we're launching here in the next week or two, first part of July. Is when I got started years ago, I was on the road traveling, going from city to city and meeting with so many investments, speaking and meeting with bankers and asset managers. Well, we decided to kind of redo that as well. So we've got a 40-city virtual tour kicking in here next month. So stay tuned for that, as we'll be doing specific webinars on each of the top 40 markets we've identified. We'll have a website up and running here shortly with you guys with the different times and the schedule. Basically, we'll be hitting 40 cities over roughly about 45 days virtually for you guys. So stay tuned for that good stuff there. But once again, guys, we are honored to have you guys here join us tonight. You're here to meet the banker. And so we're honored to have our banking buddy here. Our special guest interview tonight, he has over 20 plus years in the mortgage market, not just as an originator and a mortgage broker, but also on the distressed side, special asset side. I originally met him when he was the portfolio manager at Vertical Fund Group, bought some notes from him. Non-performing, we've always trying to trade it back and forth, resources for performing or people buying and selling as well too. He's the founder of Revolution Mortgage, and along with being the founder of the Northern Star Mtg Fund, he calls Irvine, California home, and one of the first speakers at one of my Note Mastermind groups about 5 years ago. So I'm honored. Rich Mason joining us here tonight on Note Night in America, man. What is going on, Rich?
Scott, it's so good to be with you. Here remotely, a little different than coming to the mastermind and speaking in person, but as you can see, this is the new reality, the home office. You know, I have a data tape up on my computer behind me that I've been pricing out this afternoon, and this is what life looks like now.
Yeah, exactly. Tommy Bahama shirts and basketball shorts is the new norm for those.
Exactly. But you can't tell.
I put a collared shirt on tonight. I guess I got too dressy for you, huh? So, Rich, why don't you share a little bit about kind of what the your little bit of background. Now I gave a brief, a little bit of your history. So share a little bit about your background and why people want to listen to you tonight.
Yeah, no, it's good, Scott. Thanks for having me with you. It's great to connect with you as always, and people involved with you. And I have just the utmost regard for you and your training. So it's exciting to be with you. As far as I go, it's all mortgage banking and secondary marketing. I worked for some of the big subprime lenders out of college, and then I opened my own subprime retail shop. Ran that for about 10 years, regional. And then after 2008, I got into secondary marketing, distressed mortgages, helped run the trade desk at the Vertical publicly traded fund for quite a few years. That's where you and I met for the past 4 years. Been a little bit back in the origination business, but been primarily buying distressed loans of all kinds. So really have our finger on the market these days, and it's definitely changed dramatically in the last 90, 120 days. But personally, I think it's a really good time to buy. I think it's opportunities like this just don't come along that often, where you have big downturns, and if you're able to set aside your fear and your worries that the future is just going to implode, there's probably some good buy opportunities out there right now if you're smart.
Yeah, I would agree to that too. We look back to how I'd love to ask you what your thought was in the market, say 1st of January, because I think when we first met and when everything hit the fan in 2008, 9, and 10, especially in 2010, I think a lot of us that were trading were like, this is going to be like maybe a 3 to 5 year cycle. We didn't think it would last a little bit as long as it did, and it went a lot longer.
Yeah.
And the market kept going up, and even as last year, I think you and I were talking about the market. It's like, it's just crazy. I don't think it can keep going, where it's headed. So thinking back to the first year before we hit Corona and social distancing and all that good stuff.
Yeah. Fun.
It's a crazy 90-day period now. You said there's some great opportunities. So let's talk a little bit about that. Where do you see current opportunities being at right now? And then maybe we'll fast forward to the second half of 2020 to the first of the year.
Well, I haven't been doing this particularly in the distressed mortgage market, secondary marketing side for the past, I don't know, it's coming up on 10 years now, I guess. A lot of my focus early on was scratch and dent. And as that just got more and more competitive and the margins got more and more compressed, decided it was time to branch out. And so we did that. And so, right before the downturn, we had, for the most parts, exited the scratch and dent market completely due to just the competitive environment. And we really branched out. So our favorite trade before this whole thing happened, and I don't know that it's really changed much, but before this happened, we were buying a lot of RPL mortgages, reperforming mortgages, pretty wide box. They could have made just 2 payments in the past 12 months or 12 out of 12, and we really don't care. I have to say our biggest 2 drivers are yield and equity. And we can look past almost anything else if we have those 2 components. And property type, we'll buy some really funky stuff as long as we have equity protection. And that's even more so in this market, that I'm still looking for yield, still willing to take on risk, and even a little bit more so now, I just have to have that equity comfort, because no matter what happens, if you have enough room, people are always going to need houses to live in. Maybe the rents go down, maybe your payment streams go down, whatever, but you're still going to have a performing asset, just maybe at a lower level for a while. So we buy, performing conventional mortgages. We'll buy the, kind of the orphaned loans that, were non-QM stuff that were meant for all these investors that stopped lending in the last 90 days during the pandemic. Land contracts, seller financed loans, private money loans, just about anything. And as I said, our 2 primary criteria are just, what is our yield going to be? And do we feel safe that if things continue to deteriorate, which we don't necessarily think they will, I actually think things are going the other way. It may be a slow recovery, slower than, I don't know if it's going to be the big swift V that people have talked about, but I think it's going to generally go up for quite a while. Some bumps in the road, maybe some ups and downs, but I don't think we're going to have a W. That's my personal opinion. And so we're excited to buy into this market, and we're seeing quite a bit of stuff available. And it seems like pricing has come down.
Yeah, let's dive into that. What kind of yields are you guys looking for when you talk yield? Maybe explain that a little bit to our listeners, so that you're not going to get. Because I guarantee you're probably gonna get some invites on via LinkedIn, and people are like, "Hey, you want to buy my note?" So let's clarify that, what you ain't buying. Save you a little bit.
Well, here's kind of my benchmark. So I always know. So I have friends who have run hard money or private money companies for decades, right? So I know that I can just pick up the phone, call one of these guys, and have virtually zero risk, because I know their underwriting criteria. They're very safe. Low loan to values, and I can get 10% without lifting my finger, without having to do any work. I can just go on vacation. I don't have to work 1 hour a week. They manage the loans. They do everything. I literally just send them the money and I get a 10% return. I get a monthly check. So it has to be better than that for me, right? That's kind of my bottom line. And other people may have different investments that they like. So for me, that's kind of where I start. So when I look at it, I look at my initial yield at my discounted yield. What am I getting on a cash flow basis? So I have my discounted yield. I have my cash flow that I'm getting, which could be higher than the discounted yield, depending on the term of the loan, if it's shorter. And then I have the discount amortized over time. I personally am usually pretty conservative because you just don't know how these loans are going to perform. I think that's probably everyone's little special sauce, if you want to call it that, is how long do they think the average lifetime of this portfolio is going to be? You know, if someone's got a 2% rate that's never going away, my personal opinion is that guy is going to pass that loan along to his kids, right? And everything else, if you have a super high LTV borrower, you know, it's less likely and the only exit is a sale. You know, what parts of the country are they living in? I mean, there's just literally unlimited factors that go into that analysis.
Sure.
So I usually try and be conservative, and I look at an 8 or a 10-year period and divide up that capital gain and add that to my yield. And if that gets me over 10, I'm interested. And then I got to look at the overall risk of the loan, and maybe I have to bump my price up a little bit more based upon if it's in a long-term foreclosure state, or if it's rural, or if it's had a really sketchy payment history, or it's got a sub 500 FICO, or you just tons of different things, right?
Yep. No, that makes a lot of sense.
That's kind of how we generically look at our pricing.
Right. There's a lot of factors that go into it. When you talk, let's talk about a little bit of the equity side too. You mentioned that.
Oh, sorry.
It's okay.
Sorry. Go ahead.
So you're talking about an equity, wanting to have equity in your loans. Is that you're trying to be at least at 20, 30% equity, or is what's that? I'm sure the number changes. Obviously, it's a higher interest rate with performance. It's probably a little bit less equity versus somebody with a low credit score and low performance history, correct?
Well, it's just all over the place. Let me just give you some examples. So I'll tell you, I paid, which everybody will think this was probably overpaying, but I paid in the 80s for a pool of land contracts.
Sure. Smaller
balance, not rural, not really, kind of, suburban, semi-rural, kind of a mix, right? So I'm paying upper 80s. The coupon was 11, which is fine. So I have a nice yield. But the kicker was these things, every single one of them was below 50% LTV. The average seasoning on these loans was close to 10 years, and they were 20-year loans. Some of them were like at 20 and 30% loan to value.
Wow.
So basically, I'm getting better than I can get with a hard money. I still got, a 10 to 20% cap gain. I have a short, those loans are going to be paid off in 10 years no matter what. So I'm getting at least a 2% bump, if not more. So on something like that, it's really individualized, the pricing. If I'm looking at, sub-performing loans, if something has a lower coupon, I'll buy. I think my minimum coupon is probably around 5%. It's not that I wouldn't buy below 5%. It's just that the discount is going to be so drastic to get to where I need to be. It's just unrealistic. I mean, unless the seller's super desperate or there's something really wrong with the loan, people generally aren't selling in the 30s and 40s, right? But so if it has above a 5% coupon and I can get to where I need to be, I'll still price. I'll do trades. I'll buy loans that, I'll bid 50s and 60s on some stuff, and we'll get some deals done in that price range, mid 60s, high 60s, low 70s. I really look at, I'm not as concerned about things like FICO score and some of the more traditional metrics that I'm really looking at it loan by loan, and we don't buy in such volume that I can't do that. I mean, I can really look at every loan, envision the borrower, what they're going through. I mean, I could look at a loan, the guy's 2 years past due, but he made 11 payments in the past 12 months, right? Things like that.
No, that makes a lot of sense there. You've got somebody that wants to stay in a house, obviously, and went through some sort of financial hiccup, layoff or medical or divorce. But if that's the same thing I look at, hey, somebody's still 2 years behind, but they made 11 straight payments. That's kind of motivated. I'm willing to worry about the back payments, put on a forbearance agreement, put on a face amount loan, and roll from there, right?
Well, and you know what else is interesting? And I don't know if I said about to do this, but so we own currently about 250 loans that we're servicing and own outright. A lot of those are in the middle of the country. We have very few coastal loans, and we have lower average loan amounts also. And I didn't really set about to do that. It's just kind of the way things happen. But now in retrospect, I can tell you, I have had, out of 250 loans, I've had 2 forbearance requests in the last 90 to 120 days. And those people are in touch every month. They say, "Could you give me one more month? I'll pay my escrow so that doesn't get behind. Just can you waive my interest and principal?" It's amazing. I mean, I'm thinking some portfolios, have a lot higher forbearance than that. Maybe, I don't know what the numbers are, 10, 20%, 30% on some, I'm not sure. So that's been amazing. So really, looking at your average loan amount, your locations, what you foresee in the future. I personally am not really excited about. I used to love the coasts. The coasts used to be a bonus, right? And now they're a detriment. I actually downpriced for the coasts. And I can tell you something else that I realized during this downturn is I had a loan. I purchased it not that long ago, maybe 6 months ago. Perfect payment history, 750 FICO score, low LTV. So no matter what, I'm protected. But that's a loan you would look at and think, we're bulletproof. That thing is going to pay like clockwork. I'm never going to have to talk to that borrower one time, right? During this downturn, both have lost their jobs, right? Sweet people, they're in communication, but they're one of the 2 loans that went into forbearance with us. So that's something else that I think this type of unusual downturn that we're in. It's not just kind of like the economy slowed down. It's a very unusual downturn that we're in. And it's even very different than the 2008 downturn, which was a financial crisis. And it was a loss of equity. And but people were still working. The GDP didn't really go down. It was a totally different deal. This one, you've had sudden loss of employment, sudden downturn in GDP. It's really a different animal. And sometimes it's just the basics are so critical, that equity position that you're in. What could be more important than that equity foundation? And some people, I know some models, they'll overlook that based upon other criteria, or they'll weight it down based upon other criteria. And that's always my number one focus. No matter what, I'll take less yield to have equity. But just the fact that borrower went forbearance, when I looked at that loan in that portfolio, that was probably the one loan I said, those people will never have a late payment. And they were one of the first to have a late payment. So it just tells you really, it's a good time to analyze your buying criteria, I guess, and your underwriting criteria. It's a good time to analyze your portfolio right now and really see, what's happening. Because I also don't think that I do think we're going to come out of this, but I think we've entered into a new situation, with some of the geopolitical stuff that's going on and the political stuff that's going on, the economic stuff, the employment, some of these changes are permanent. You and I were talking before the call about it'd be a terrible time to be an investor in office, right? And that's not going to go away when we come out of this. It's going to be a 10-year to get back to equilibrium in office, right? So I think it's good to look and see what changes have happened that are permanent and how are those going to affect your portfolio and what you buy moving forward in your criteria.
Yeah, I couldn't agree more with you there. And you think about, I think, I read an article that Google there in Santa Clara has given every one of their employees $1,000 check to buy office furniture to work from home.
Right, yeah.
That should tell you something, everybody. I mean, we've been virtual for 5 years. I mean, we still have an office we work with, but our team works remotely. But you look at others out there. I mean, I was just talking with the head of public relations for Buffer.com, social media platform. and their 12 employees worldwide have always worked remotely. So, with Zoom being the new norm, you can do it whether it's in the office, in a closet, if you're the Supreme Court, if you're in the bathroom. They think about all the stuff that you can do remotely now. You've really got to pivot to make things happen. So those asset classes that have required, the industrial, the office space, even the big box stores we know have always been hurting for a while now. I think you've got to find some flexibility if you're going to be diving into those asset classes to be able to pivot or create something else, right?
Mm-hmm.
Now, you mentioned non-QM stuff. Would you share a little bit what you kind of consider non-QM and what kind of comes across your plate? Because I've been seeing a lot of stuff today, and you and I need to talk tomorrow because I just had an interesting email with a non-QM guy. But share a little what you're looking at the non-QM side.
Well, it's been interesting. I'll tell you, we haven't bought a lot of it, and talking to people who are out there, not a lot of it is trading. I mean, the feedback, the intel I get is, somebody will go to market with 100 loans and they trade 10 of them. And that has 100% to do with the price expectations and what the market's willing to pay. There just has not been an equilibrium formed in that. It was just so sudden. I mean, to have all these loans, it was just like the subprime meltdown. I mean, you have 30 funded loans, you're planning on shipping the new century, and, you get the email saying, hey, we're not buying anymore. It's, and every other lender you go to, they're not buying anymore either. So I think it was very sudden, and that's why there hasn't been price equilibrium. But for me, the non-QM stuff is just, anything that can't go conventional or jumbo conventional, just anything that has irregular income, even the larger loan amounts. So, anything over the 680 is almost non-QM now. Some of the jumbos coming back, from what I see, but still, that's primarily what we saw. It was income related and loan size related to a little bit of credit score stuff, but that's the non-QM space. And we bid it. We haven't really been bidding a lot of it recently. Like I said, we just got so little traction. When the feedback is you're 25 points off, right? There's not much to do there. And when you keep getting that feedback and you keep hearing the loans just aren't trading, so I think there needs to be a narrowing there for that trade to happen.
Yeah, I think there's definitely a divide between those that have it and then the buyers. A lot of knee-jerk reaction. Oh, we're going to offer pennies on the dollar. Well, we know we've got to bring it up to something that makes sense, 40, 50, 60 cents that's protected with the yield and then also the equity position and figuring out that there's going to be a drop in some value. But then also the guys that have this stuff, they don't want to take a bloodbath for it. That you got to really really spend the time finding the right buyer for the right product. And then the same thing, as you mentioned, finding the right product for your portfolio. Not everything makes sense.
Well, the feedback I got on that was, that stuff, they're looking for low 90s, maybe high 80s. And, the coupons aren't really that great on those loans. I mean, you might get into the 5s and 6s. Some of them are 5, 6, 7, 8, but a lot of them aren't. And so it just hasn't happened. And the thing is, where are those loans that those guys have to sell them? Like, so are they sitting on a warehouse line that they're getting called on and they don't have the financial capability of taking it off the line? Then they're in a desperate situation. My feeling is there's just not that much desperation on the non-QM side. Those guys who were running those funds and those companies had to have a fair amount of capital going in, and maybe they're okay just holding on to those loans for a while.
Yeah, and I think there are a lot of them are hoping, and who knows what's going to happen. And I'd love to get your insight on this. Hoping that the government's going to come and bail out a bunch of people, though, too, on the mortgage side. What's your thoughts on that?
I don't know. I haven't heard anything. I personally haven't heard anything about that happening. It doesn't, I guess the only thing they would, I think the government's more inclined to go down to the individual level right now is kind of their focus. And it's not like the banks really need to be bailed out. I mean, the big banks, it's the other companies, the banks seem to be doing fine. They're well capitalized. I mean, I'm sure they'll take the money, and I'm sure they're giving them some for the forbearances, but a forbearance isn't really a loss.
Nope.
Really, it affects, the cash flow and the bond payment and all of that. But if there's liquidity there, you're just tacking on 6 payments to the back of the loan, or even 3 payments. That's why I don't even really mind doing a forbearance. Once again, if you're in a good equity position and you can help somebody out, some blue collar guy in Ohio who's living on $3 or $4 grand a month or whatever it may be, and I can go, great, we'll just tack 6 payments on the back of your loan, no problem. We're fine, and it helps them, and we still get paid in full eventually, so it's not a loss to us, and we help somebody out. I don't know why, as long as you're in the position to be able to do that, it seems like a no-brainer.
I agree to that too. That's one of the things I told my staff is like, if you get a phone call for a forbearance agreement, let's just go ahead and give them 60 days. We'll extend it and go from there. See if they're working. I do have a friend who's got a fund that he had 6 borrowers call and ask for forbearance agreements, and he did a little research and found that all 6 of the households were working full time too. So you have some people trying to take advantage of the situation.
Yeah. Well, and it's interesting. I'll tell you some other strategies that we're implementing right now. And I like the size that we buy at. We're bidding on stuff at 10 million below in UPB, and we'll buy a single loan. So anywhere in that range, right? But it's just amazing that if you're diligent and you're willing to look at a lot of stuff and do the pricing and keep the relationships going, you will find the loans you want to buy. I'll give you an example of how you can do well right now. I just bought a loan, literally just bought it. And within the last, year, 6 months, got a nice discount on it, paying borrower, right? A few funky things about it, but good credit score and good equity, right? And good payment history. So I boarded the loan, and I called the guy up, and I'm like, hey, we're your new servicer, la, la, la. Looks like you have a good credit score, and it appears you have enough equity. Have you ever thought about consolidating? Because he had multiple mortgages. I'm like, have you ever thought about consolidating? Hispanic borrower, multiple people in the house working, probably a tricky loan, but it looks like it's going to get done, right? And so we'll take we paid probably 70 cents or something for that loan. We'll clip, 50, 80, $100,000 capital gain in 60, 90 days if that loan funds. Now that's just one loan out of a whole portfolio. They're not all doing that. But still, if you can do that on one loan and then something else on another loan, and you can really accelerate your returns is what I'm saying. If you're loan specific and if you're multifaceted, another strategy that we've developed is on land contracts. We have found that a lot of the land contract borrowers would prefer to have regular mortgages because they know their entire equity is at risk, right?
I was just going to ask you that.
And so, to me, once again, if you're in a good equity position, does it really make a difference for me from a security position having a land contract versus a mortgage and a note? Not at all. Great. So I may have to spend some more money kicking them out, but I'm going to get it all back because there's plenty of equity. So once again, it's just as long as you have capital, liquidity to do these things, you're well positioned. And so we'll go and we'll offer people with land contracts the opportunity to refinance into a mortgage. They love it. It's very low. Doesn't cost a lot of money to do that from a servicing perspective.
Right.
We'll shorten their term, right? So it bumps up their payment, shortens their term, so we get our capital back more quickly. We buy a discount, so that boosts our yields. They love it because they now have a mortgage loan. They don't feel like this, hammers over their head that they could lose everything if they somehow stop paying, and they actually own their home more quickly. So as long as they can afford the payment, that's even a benefit to them as well. So it's once again just being creative and really trying to maximize your portfolio and thinking about these strategies when you're buying. I think another thing that's really important, Scott, is as we're bidding portfolios, if you don't get into due diligence, you don't have a chance to buy the loans, right? And so I think about that. I am not overly picky when I'm bidding, right? I try and err on the side of caution. I can say, oh, this could be a problem, but it might not be a problem. It's unknown, right? So, why put the cart before the horse? I give my best realistic pricing up front, and then I get into it, and I know that if I have a good counterparty, I want to buy loans at a fair price. They want to sell loans at a fair price. you got to get into due diligence to have a chance. So then you get into due diligence. Well, then you can have a conversation. You can say, you know, this is how I priced up front, but now look, we have this, this, and this. This is what we think is fair. And you get it done. Where if you price that way up front, you never even get to have that conversation. And they don't get to sell a loan, and we don't get to buy a loan. So I really, you know, I've just developed that over the years where I don't want to be too loose where you create false expectations, because that doesn't work, right? And then you just, you know, you get a bad reputation as a bidder, and you definitely don't want that. As someone who has a low pull through, you don't want that. And not being so worst case scenario and everything that, because when you're selling loans, you have very little fear because you know every fact about that loan, right? So when you're selling loans, it's a whole different thing. You're so comfortable because it's your portfolio. You've talked to the people, you've owned them for years. You know what the deal is inside and out. But when you're buying and you don't have that comfort level yet, you know, you can have a lot more fear, and that can result in kind of lowballing the pricing. So you have to just kind of keep it a little bit, you know, have some faith in the process and not be quite so tight up front.
Well, and that's a big fear we see from people, that they will judge based on every worst case scenario on their ROI calculator. And I'm like, kick the ROI calculator out until you get a true bid back or get deals accepted. Because we all know we could kill every deal with every possible worst situation out there. You know, if you take the common sense out of it and you just go to the worst side. But you're right. Getting the bids in, getting into due diligence, even if you've got the bid a little bit higher than expected, but then as you dive into it, you know, sellers will fade bids if they're understanding things. Oh, the value's not there on this one. There's some troubled children here. You know, okay, we'll fade it down to make a deal happen versus, okay, let's start to try to retrade the whole damn thing over another 90 to 120 days, right?
Well, yeah, and sometimes I'll get into it and, you know, I'll be like, well, I'm really kind of paying up for this one. I peaked my bid on this one, and then we'll get our BPO back, and it comes in 50 grand higher. Now my LTV is 20 points lower. I'm like, oh, this is fantastic. No problem.
Mm-hmm. Exactly. You just got to do that journey versus killing the deal on the front end. Now,
that's right.
How much are you guys following up with bids that maybe you didn't succeed on, and then following up every 30, 60 days? Are you seeing some pull through and closings from that, and just being diligent in your touching base with your sellers?
Yeah, that's good, Scott. We're probably not the best at that. That's a good strategy. We are not having an issue to date deploying our available capital. So we haven't really had to do that. But you know, we have a marketing program. We send out emails once a month to our database that we've developed over the last 10 years. You know, that seems to work. You know, what I do when I have money sitting around that's not deployed, I just pick up the phone. I've called you in the last month or two and said, hey, we have money to put to work. You know, your people have some reporting loans that they want to sell, some NPLs that they've turned around. And that's what I do. And I just start at the top of the list with people I've done the most business with. And I just work my way down, because there's so much in this business to be said for that relationship. That first trade is absolutely the hardest. And, you know, you don't really have that trust level completely. And so you're having to double check everything. And people are always seeing if you have an ulterior motive. And
right.
Until you get that first trade done and you go, okay, great. You're above board. I'm above board. This is great. Let's do more business. Definitely the first calls I make are the people that I've done business with.
Yeah, I agree there. Jeff Wolf from out in San Diego asked the question, what's the percentage of winning bids do you end up fading, if you have any idea?
The answer to that question is it 100% it's 100% related to the quality of the data tape. 100% related to the accuracy of the data tape. I do like bidding, you know, so you get like, you know, the Mountain Views of the world, or Citus now, but, you know, and other intermediaries like that. The thing I love about that is they have a whole department dedicated to putting that data tape together. And not only is it accurate, but it's like 100 columns wide. There's more information than I would ever use, right? But everything that I would want is on there. And it's amazing how many data tapes that I get that either are missing stuff that I think is important. Now, can I price without it? Absolutely. But the accuracy of my pricing is going to go down. You tell me they're current, but can I see what they've done? Give me a 12-month payment history so I can actually see what they've done. You tell me the interest rate, but what's the P&I payment so I can make some additional calculations? You could just go on and on forever. And the more detailed the information gets. So I have found that when the information is extremely detailed and extremely accurate, meaning my BPOs come back, they're within tolerance. The credit reports get pulled, and what they said is what's actually on the credit report. I review the payment histories, and the payment history is actually what the data tape said. The rates match up. There's no other red flags on title that pop up. Then we'll buy 100%. I mean, there's really no reason not to buy every loan on there, and we will. And sometimes it's the opposite of that. We'll have tapes, we'll get a due diligence, and the BPOs will come back and they'll just be like, just really low, yeah. And yet, I mean, I've had trades where we've like seriously kicked 80 or 90% of the loans. We've come back and said, we'll buy 2 out of these 20. They're just, they're trash.
Yeah.
And then of course the seller's upset, and we're like, well, don't worry, because we'll never bid anything from you, so you don't have to worry about us buying from you, because you just wasted our time, because this is ridiculous.
Yeah.
But it's usually not like that. People usually don't intentionally mislead. And, I think when you get, I always ask for stuff too. I get a data tape, I'll get an initial review, and I'll just say, hey, our FICO score is available, our updated value is available, our 12-month pay history is available. I mean, these are the things that are critical to us in pricing loans. And if they are, great. And if they aren't, we say, great, we're going to price it as is, but we're just going to make estimates. We're just going to throw in an estimated average credit score, and we'll just assume that everybody's made their last 12 payments on time, and we'll go from there. The thing that's almost impossible is if you don't have values.
Yep.
If the seller doesn't provide an updated value, that's really hard, because am I going to take the time to go in and look up Zillow's, all these, and then you have no idea, Zillow's off by 30% sometimes, right?
Exactly.
Especially in smaller areas, and it's even more inaccurate. So if there's not values, that's probably the one thing that we just absolutely will not bid if it's a no value tape.
Do you have a size of the city that you're buying loans in that you like to stay above as far as like population wise, or?
We don't really city population. We just look at it as more like rural, semi-rural. We'll buy loans in the middle of nowhere. Once again, it's really just yield and equity driven. If there's a 9 or 10% coupon, and I can pick that loan up at 40 cents on the dollar, but it's a full-blown agricultural property with a house, 5 miles out of town, and the town is 1,000 people, but it's got a good pay history, I'd buy that loan.
Yeah. You wouldn't move there. Your wife would move there, huh? Right.
We're not going to go be owner occupants if we take it back, but but those people tend to stay in those properties a long time.
Yeah.
So if they can pay, they will. And even that property, so if you do have to take it back, at 40 cents on the dollar, you're at least going to recoup your initial investment. You may lose your capital gain, maybe, but you're going to get your money back at least.
Right. Capitalization. How are you guys capitalized? Are you using your guys' own funds or
we are.
Okay.
It's funny you mentioned we've never really taken on investor capital. It just hasn't been our cup of tea. If we needed to, we would. It's interesting you brought up the government. I've actually been thinking about pursuing that, because we did get some. It's amazing. The federal government will literally just wire you money right now. It's literally they'll just send you an email. Hey, you're approved for this. Sign this, and a day or two later, there's 6 figures in your bank account. It's hysterical. But I guess when you're doling out, hundreds of billions or trillions, what do they care, right? But it is pretty loose. But this time around, I don't know if the government is really putting much money into the real estate and mortgage arena, because there's so many other places that are just really hurting, right? Just people who can't pay their mortgages getting direct payments, or can't pay their rent, people out of work and, increased, unemployment, and then all the industries, the travel and restaurant, just all those. I mean, they need so much money. But I have thought about, I don't know how much I want to be in bed with the government particularly. I really need to think that part through. But to say to the government, hey, we will provide liquidity. I mean, it's exactly the same thing they did in 2008. It's really, they're just not doing it because they're doing all the other stuff. So to say, hey, look, we'll buy these loans that are in forbearance so those banks can make new loans, right? We'll buy loans that, that are trading discounts because the borrowers are past due, or just, all the myriad of stuff that's going on. Just provide liquidity at all levels of the spectrum, just makes more money available for new loans, or to give people more time to get back on their feet.
Right.
We might do that, take some low interest rate government money and redeploy it.
When you guys were at Vertical, you guys had a pretty interesting way of raising capital, going the broker dealer desk wise. It's turning your shares into mutual funds, if I remember correctly.
It was very unique. I think that was the only mutual fund in the mortgage loan space. It could still be. I don't know. But it was interesting running the trade desk, as a consultant for those guys, and seeing the capital raising. I mean, that was a very institutional capital raise, and just still to see the amount of time and effort and cost and oversight,
right,
and that goes into that, and every investor is somebody's hand you have to hold, right? So if I could just get one guy, hey, I'll write you a check for $50 million or give you a credit line, and it's me and you, and that would be one thing. But if you have 500 individual investors, and they're all uncredited, but still, even if they're worth a few $1 million, they're probably, some of them are going to be more worried about their investment than others. I mean, it could be a bigger deal to some than others, and
right,
fluctuations and explanation. Yeah. So we haven't gone there, but.
If you were, I got a question from somebody on your Terry had asked a question. He goes, if you were just getting started as a note buyer, note investor, where would you go first to find notes to bid on?
I'll tell you what I did, and I think this is, when I got into the space, it was 100% networking. I mean, I literally just started going on LinkedIn, and it's easier now because there's just so many. It's much. There's so many trading groups and note buyers. I mean, there's huge groups, but that's what I did. I mean, I started a few of those groups, and this was like 10 years ago, and literally just started networking, getting people on LinkedIn to connect with me, and then I would access their email, and I had a whole process in place. Then I got their email. Then I had my first email I sent to them, and then I had wanting to get a call, and then I would just go to the conferences. And when I didn't know anybody, I would literally I never went into any of the presentations, literally to this day. I mean, however many dozens of conferences that I went to over the years, I seriously, I never went into the presentations. I maybe like one or two, out of, 30 conferences. I sat through a couple of presentations. I would just take a whole stack of my business cards, and I would stand right outside the big doors where everyone's going to come out after the presentation. And I had like a 20-second spiel, Rich Mason, Northern Star Mtg Fund, we buy discounted mortgage loans. What do you do? And if they say anything that wasn't related to that, I would say, have a great conference. My name's Rich Mason, and I would just, you know what I'm saying? And I could meet probably 100 people in an hour, and then you spend maybe 2 or 3 minutes with the people who are engaged. Just have a pen, you just write down, this is what they do. They buy MPLs. They sell RPLs. They're just whatever the big point is, write it on the back of their business card, stick it in my pocket. Great, I'm going to follow up with you, the next person. and then just walk around in the meet and greet area the whole time. Just, hey, what do you do? What do you do? What do you do? And find the people that are doing it. And then, you know, when you don't have a lot of capital, you know, it's okay, because you can get in there and you can bid something. You can bid a smaller pool. Say you only have a few $100,000, right? Or whatever it is, you can still go and bid a $2-3 million pool, loan level it out, and then just when you hand it in to the seller, whoever it is, say, look, I'm looking to deploy $300,000. So if you want to, you know, cherry pick one or two of my bids, I'd be happy to do it. Or, you know, this other strategy still works. I was talking to a guy and telling him, you know, love the RPL bid, firsts and seconds, and he's all, oh, well, you know, I actually have a pool of RPL seconds right now. I'm on beautiful home run. He goes, it's about $70 million in RPL seconds. I'm all, that's a little big for us. You know, we're not even going to take a sizable carve of that, right? I mean, that's just to scale, right? But I said to him, but we love that stuff. We'll buy a few million. So if you have a tail, or, you know, there's going to be kicks, right? Where hopefully they'll probably sell that institutional, but, you know, they're easily going to have 5 million in kicks, or just whatever stuff that just doesn't trade through. We'll buy all that. Send that to us. So strategies like that. But the number one thing is just networking and getting out there and just meeting people and following up with people. It's amazing what you were talking about, following up with the sellers. It's just amazing. Not even to be motivated to follow up, because you can be. It's just hard to follow up with a lot of people. You have to have an organized system. You can do the emails, but how many actual, like, really, where you really know the person and you've done business with them, how many of those relationships can you actively manage? Like 20? Right?
You know,
I mean, that's a lot of people to stay up with all the time.
Yeah.
Because they might be a seller once a year or twice a year or 4 times a year. So if you're not talking to them or connecting with them every month on a meaningful level, that's why I think the broker community is also very valuable. You know, people will say, well, you know, do you mind, you know, what if you buy from a broker and it's somebody you already have bought from in the past, or somebody you know? I'm like, no problem. I am so happy for that guy to make his point or two, because there's no way I can manage all these relationships. I mean, I have bid stuff where I bought something from somebody literally just months earlier, and they didn't send me the data tape, because they can only deal with whoever was most recent in mind. That's who generally gets it, right? And especially if you're dealing in multiple arenas, like, you know, if all you buy is scratch and dent, like that's it, and that's all you do, and everybody knows it. Okay, that's a little bit easier to manage, because it's 100% scratch and dent. And even though you can break that down into geographies and loan amounts and blah blah blahs and issues, you know, kick reason, whatever, it's still that. But for us, I mean, we'll buy the land contract, we'll buy the RPO, we'll buy the first and second, we'll buy the small balance in the rural, we'll buy the bigger loan in the city, you know, we'll buy the seller finance loan, we'll buy the funky, you know. It's hard to stay in touch with so many different people with so many different products. So it's great to really engage with the broker community and keep those relationships strong, because they will bring you a lot of stuff, and very important.
Yeah, I agree totally with that. It's hard to be touch base with everybody on your list. We got to have an email system. And I was looking through here, and I've probably got 40 emails from you where I know it's like, hey, you go to the conference, let's meet, let's grab a drink, you know? And I'm like, oh, I'll see you there or whatever. But that's just touching base with people. It leads to conversations. If you're not marketing to people or building a list of some sort, you know, you're not really in the business. But you build those relationships. You have those 20, 30 sources that probably feed you on a semi-regular basis, and you probably got 100 that are going to do it like once a year or once every other year. You still touch base with those through marketing, but you build your core, but do exactly like you said. Jeff Wolf said on here, Terminator networking with you at an event with the cards. But hey, go hang out at the local bar in the hotel nearest the event and save on the fee of the tickets, right?
Right. Hey, don't say it, but yeah, just go and sit in the bar in New York at the at the secondary conference. You know, You don't need to go up or down any floors. Just hang out in the bar. And I mean, literally the way I used to schedule it, I would do every meeting 30 minutes and just do like one break for lunch. And literally, so you think about it, if you start at 8 in the morning and you're willing to go to like 6 at night, you have 20 slots, 30-minute slots, right? Take a little break. You can meet with 18 people.
Yeah.
Right? I mean, we literally used to grab the same table year after year after year in New York. And people were like, oh, you got your table. We're like, here we are. You know, and once you start doing that, and then people are coming by and you see people and here's my card, here's your card, the same 2-minute spiel. What do you do? Great. If they are a potential seller to you, and even if they say like, we don't sell, but they own loans, you want to connect with that person, right? Because they will be a seller eventually. Even at Vertical, we weren't a seller, but, you know, we eventually started selling stuff, you know. You just don't know.
Yeah, I made some great money off the first 3 notes I bought from you. It was phenomenal.
Good.
Back. Yeah.
Nice.
Yeah. Good. It was a win-win.
Yeah.
What's the best? We got one question for me. Are you still buying seconds right now in this market?
Absolutely. So yeah, I love the second trade. I absolutely love seconds. I do not really differentiate that much between a first and a second, and some people think it's just such a big difference. And if you just combine them together and then underwrite it like one big balance, there's really no difference. You don't have to deal with taxes and insurance from the second position. There's a lot of stuff that you don't have to deal with from the second position that's nice. And once again, if you're in a good equity position, I don't mind. I've had firsts foreclose and I got to sit around, wait for it to go to foreclosure, wait around for the city to get their act together. But 2 or 3 months later, check shows up in the mail for my full balance. Thank you. No problem. But I love seconds. I was going to tell you, just in this specific market, I am actually, not only am I like a buyer in this market, I am ecstatic to buy in this market. Like, you know, Warren Buffett and all those guys like him sit around waiting for the stock market to tank. That's when they buy. They are, you know, they do little buys all the time, but that's primarily when they're storing up $100 billion. They're waiting for that once in a 10-year downturn where they can go in and buy quality companies at discounted prices. No, you know, Warren, you guys have probably heard it, but, you know, Warren Buffett says, you know, when everybody else is in fear, that's when you want to buy, right? And when everybody else is in a frenzy, that's when you want to sell or stay neutral. So I love that this has happened. I love that there's continued, you know, that I don't want to call it fear, but just a lot of uncertainty, and it's continued. It looks good for a while, and then, you know, something happens and people get concerned again. And I think it's an absolutely great time to buy. I am, you know, slightly more cautious because I think in the long, you know, the 5, 10, 15, 20-year horizon, it's all good. Just all goes back up on the long-term trend. But there could be slower payment streams over the next 12, 24, 36 months. You know, unexpected things could happen. So once again, I want to keep dry powder because I want to be able to ride out the storm, whatever that is. And maybe I'm slightly more cautious on, as far as my bid, it might be a little bit lower, right? For sure, because prices have definitely come down. So my bid is lower than it was 90 days ago. But, you know, so I might come back a few points or whatever just because, you know, it is a little uncertain. But I think it's a great time to buy. I want to deploy all my money right now.
Amen to that. Amen to that. When there's blood in the water, it's the time to strike, not waiting around for it and waiting for the.
Well, and, you know, like you said, a win-win situation. It's one of the reasons I love the RPL buy. What is a better win-win situation? You got somebody who went out and paid 3 cents or 10 cents or 20 cents or 30 cents for an NPL loan, depending upon which kind and whatever, equity or not. And then they work, and then they get the thing turned around, and the guy makes, you know, some amount of payments over a 12-month period of time, 6, 7, 8, 10, 12 payments. And they can turn around and they can sell that loan and double their money, triple their money, and they can still afford to sell it to me where I can make a good amount of money still, but I'm not going to have to do nearly the amount of work they did. Yeah. Maybe a little, you know, there's still some borrower communication, but not like they did. So they're getting paid for their work. I'm still getting an above average yield, right? And I'm comfortable with all the background noise. Yeah. I love that buy. It's just a win-win for everybody.
Yeah, exactly. What's the best way for people that have got something to run it across your desk to see if it's something you might be interested in, Rich? Because I got people here right now on the call. How do we get a hold of Rich to send them some stuff we got?
Yeah. Well, Northern Star Mortgage is our website. Northern Star Mortgage spelled out. My email is my first initial R, last name Mason, Mason, at northernstarmortgage.com. Or just call me or text me on the cell, 714-273-8547. We have money to put to work and would love to do a trade with you.
Awesome. Or you can always email me. We'll make sure to forward it on over to Rich as well, too, for you there. So, definitely. Rich, man, thanks as always, man, for coming on. Always great catching up with you, connecting. We'll be in touch some more as well, too. You be safe out there in the
you bet.
Craziness of Irvine.
Yeah. It's crazy here, Irvine.
Crazy everywhere, brother. Good stuff, man. Enjoy your evening. Thanks so much for joining us on here, Rich. Appreciate
Thank you, Scott. God bless.
You too, man. Be safe. All right, guys, that's going to wrap it up for Note Night in America tonight. Thank you again for joining in. Hopefully it was valuable for you guys out there listening. Your favorite, Tamika says, how many people have said you favor Mark Cuban? Oh, you favor Mark Cuban. You look a little bit like Marky Mark there, Rich. Good stuff. Just drop me an email, guys. We'll make sure we're glad to share his contact information. You just drop me an email directly. It's scott@weclosenotes.com. But otherwise, guys, have a great evening. Be safe, and we'll see you all later. Thanks, Rich.
Thanks, Scott.